Hello, welcome to Insignia Investments. My name is Rupatim Dotto, and today I'm going to discuss with you what an optimal portfolio should look like based on your age. Let's begin. I've received a lot of queries about how to construct a retirement portfolio from a lot of people, both in the form of emails as well as comments in the videos. So to make this video, I actually refer to a lot of research material by people who are actually full-time financial workers. They have worked in this field and they know how portfolio should look. One specific person's research that I have used extensively for the creation of this video is that of Professor Burton Malkiel from Princeton University. You can refer to his works. It's a wonderful piece of work, and most of the recommendations in this video are based on his research. If you're a returning subscriber, my apologies to you for not being able to make videos over the last 2 months. I recently joined a job and I was hopping all across India. But now that I'm done, I'm here and I'm here to help you learn better. With that out of the way, let's begin. Today's video will be broken into 3 parts. The first, the assumptions that we are going to take while building this portfolio. The second, the different kind of instruments that we will be using for building this portfolio and the rationale for the same. And finally, the portfolio structures for the different age brackets. So the assumptions. The first and the foremost assumption is probably from the Indian context. That is the difference between investment and expense. In India specifically, a lot of people think that buying or purchasing gold, houses and cars is a form of investment. Yes, if you buy a house today and sell it 10 years down the line, you'll be able to make some money out of it. But we will not be treating that as a part of your investment portfolio in this tutorial. We will be treating all of those expenses in the form of a consumption-based expenditure. So if you're buying a house, that is vital for your existence. Hence, we are not going to actually treat them in this portfolio as a form of investment. The stocks that you're going to invest in, they can take a downturn because they will not be affecting majorly your chances of living. But if your house goes away, it will actually affect the way you live and the chances of your survival as well. That's why we have made this differentiation at the beginning of the video itself between investment and expenses. Secondly, the assumption is that we have broken the portfolios into 4 age brackets, the first being from mid-20s to mid-30s, and from late 30s to late 40s, from early 50s to mid 50s, and finally beyond the 60s. Now, the different kind of instruments that we are going to be focusing on. The first and the foremost instrument that we are going to be focusing on is stocks. Now, definitely that's our choice of instrument because historically they have outperformed gold, real estate, bonds, and every other form of investment that you actually can think of. Because of this property and historical record stating that stocks have been able to outperform all other forms of investment, we're actually going to be investing quite a large sum of our money into stocks. Secondly, bonds. Now there is a general confusion that exists among investors that bonds have a fixed rate of yield. Bank instruments also have a fixed rate of return. So why invest in a bond rather than in a bank instrument? The reason is simple. Your savings account will not be traded over the market, but the bonds will be. So even if the rate is fixed, you can get a higher premium if the interest rates plummet or the interest rates rise. You'll be losing a lot of money in the bond market. That is exactly why we'll be actually investing in bonds and not specifically in this section in bank instruments. The third instrument of choice is cash. Cash is the only form of investment here that we are going to discuss that's going to actually provide you with constant liquidity. Irrespective of how the market behaves, this liquidity will always be able to provide you cushion against market changes. Now, when you're young, you can actually depend on your parents in case you actually come across liquidity crunch, but as you grow older, there will be no one to provide you with this kind of a cushion. Hence, as you grow older, your dependence on cash will increase, and that will be reflected in the portfolio that we will be discussing in a little while. And finally, the fourth choice of instrument will be the real estate investment trusts, REITs. That's what they're popularly known as. Now in India as of present, no such REIT actually exists. The Blackstone Group is actually backing embassy to create an REIT in India, and the news are pretty recent, so hopefully by the end of the year we'll actually have an REIT and you can look forward to invest in such a thing. But as on today, Instead of thinking about the REIT, you can actually think about taking the same amount of savings and putting it in a bank in bank instruments. Now, with that out of the way, we'll now discuss how you can actually access these things in the market. Now, there are pre-made portfolios by asset management companies that are sold as mutual funds. You can actually refer to them. In case they do not match the portfolio that I'm going to share with you today, you can spend some time, pick up 2-3 different kind of portfolios they are offering, mix them together and create a concoction whose distribution will be something along what I'll be discussing with you today. So that's how we'll be able to access all these kind of instruments in the market. Individually, accessing bonds is difficult. Stocks are easy, but then the mutual funds will be much more flexible and easier to work with if you are a novice investor or somewhere as not a very advanced investor. Somewhere in between, mutual funds are the way to go. So now finally, we'll be discussing the structure of the different portfolios. If you belong to the first age bracket, that is between your mid-20s to your mid-30s, your portfolio should have 70% of your savings in stocks, 15% in bonds, another 10% in REITs or bank instruments, and 5% in cash. The reasoning is simple. Stocks, you'll be invested in this kind of a market for the next 4 cycles, 40 years approximately. So you'll be able to weather 4 different cycles, and after every cycle, historically, the stock markets have shown an ability to bounce back. So you'll be able to harvest that bounce back to create wealth for you. Hence, the heavy dependence on stocks. Bonds, because they provide security. I know at an age of around early 20s, you don't need that much amount of security, but then what's wrong in having some? And that way you'll be able to learn how bonds function. REITs, they don't exist in India, but if they finally do by the end of 2018, you should definitely look forward to them. Instead, you can also think of investing in bank instruments. And finally, cash. Yes, I know life will be a little reckless in your early 20s, but then try to remain as disciplined as possible. That liquidity is actually going to be helpful if you are able to save it and invest it properly. The second age bracket, that is from your late 30s to your mid 40s. Now, this is the time when you're probably getting married, you're having kids, you have some commitments to meet. Because of this, you will depend a little bit more on bonds because your commitment issues are there. So we will just take 5% out of the stock portfolio and put it in the bond portfolio. So your structure, the structured portfolio will look something like this. You'll have around 65% of your investment in stocks, another 5% in cash, another 10% in REITs or bank related instruments, and 20% in bonds. This structure will help you to control your liquidity in the form of the 5% cash, as well as meet your commitments securely in case something goes wrong with the bonds. The third age bracket is actually very vital, and these are people who are probably messaging me or mailing their queries to me the most. The people who are marching towards their retirement. So these are people in their early 50s, late 40s to around mid 50s. So for these people, commitments are high. Kids have grown up, they're probably going to go into college. You need a lot more security. You cannot take that much amount of risk because you're growing old. So the structure of the portfolio will look something like this. Only 55% of your investment should remain in stocks because you'll be able to be in this market, the stock market, for around another 10 years. So you'll be able to experience one more cycle. You should increase your investments in bonds, the security part, up to 27.5%. In bank related instruments or REITs, 12.5%. I'll still recommend the liquidity to be kept as low as 5% for this kind of a portfolio. The reason is you will actually be needing this liquidity at a later point in life when you'll be entering into your 60s, your retirement will come through. So I'll want to keep that portion secure there in the 60s. So I'll just crunch myself a little liquidity in the 50s. And finally, the portfolio for the 60s. These are people who will need a lot of security. And the security is actually going to come with an enhanced investment in bonds. So for these people, they are not really here to reap harvest out of the market. Rather, they are here just for the security part. So stocks, they should make up 40% of your portfolio if you're in your 60s. Bonds should make up 35% of your portfolio. Another 10% should actually go into cash. And finally, bank-related investments, instruments, or REIT-related investments should be around somewhere around another 15%. And that should be the optimal portfolio you should be targeting if you are in your 60s. Now, with respect to stock recommendations and the other things, I'll cover that in a later video. So, hopefully that covers up your doubts regarding how your portfolio should look. I'll reiterate once more the point that I have been reiterating all across my articles on the website. That is, at least 30% of your portfolio should be tracing the market, irrespective of whether you're young or old. The reason is, market performance is what your aim should be. You should either perform better or at least the market performance. So your investment, the mutual fund portion, should definitely have 30% of your investment tracing a fund that actually goes out there to mark an index and follows that. If you're in your 60s, you should definitely look forward to just tracing the market. And with that, we come to an end to this video. If you have liked it, definitely give it a thumbs up. And if you're a first-time viewer, do subscribe to our channel. I bring advanced financial concepts and learnings for everyone to learn so that they're better equipped to handle the modern financial markets. Do visit my website. The link is provided in the description box below, and subscribe to it so that you receive a weekly update of the articles that I post out there. That's been all from my side. I hope you have enjoyed this video. Thank you. Have a nice weekend.